Sell in May and go away is absolutely nonsense. But could it be right this year? Now in this quick tutorial, I'll be sharing with you exactly why there is data that proves that selling in May and going away is nonsense. The second part of this video, I'll be sharing with you what are risks for 2022 May, because this year is pretty special. There are quite a few more risks that are different from the other years. And last but not least, I'll conclude this whole presentation by showing you what is logical that you need to think of, as well as what is the sensible action that you need to take. So if this topic interests you, continue watching on. Hi guys, welcome back. Selling in May and going away is actually from a very old English adage whereby people leave for a summer vacation. But this has been brought to financial markets and has been around every year, and that's why I produced this content to share with you, because I bet you're going to see something flashed up on your newsfeed very soon on this. Simply because this has been a topic that's been debated for many years already, and some have called it also the Halloween strategy, which is actually the reverse of sell in May and go away. What does it actually mean? There is data that suggests that performance in November to April is far superior than May to October. This is real data. As you can see over here, S&P's performance from 1970 to 2017, November to April was 6.9%, whereas May to October was only 1.5%. The difference was 5.4%. Fast forward a bit, if we narrow down to the last 20-30 years, you realize that the difference is still 4.7%. And it's just possibly, a random effect or a seasonal thing. But my question to you is, isn't there still a gain during May to October? And of course, some years are going to be negative. I don't know about it. But where do we want to go to? If we sell and go into cash, where do we want to go to? Because holding cash is very likely a silly decision. You are going to get your cash eroded. You might as well take that 1.5 or 2.1% on average, then go into cash whereby you yield next to nothing. More data to show you. Stocks don't always sell in May. This is for the last 12 years. You realize that only 2010, 2011 and 2015 were negative years. The rest were positive years. In fact, in 2013, there was 10% gain solely in May. I've also added data. 2020, it's positive, and 2021, it is also positive. Let's pull up the charts. You realize that if you sold away from May 2020, which is just after the COVID crisis, and stayed out of the market all the way until October 2020, you have missed out on 22% gains because market was at such a tremendous distressed place. What about for 2021? If you stayed out from May to October, you would have missed out 10% if you were invested into S&P 500. So next time you see news headlines, refer back to these data points and be a bit more savvy. But let's state what is very different for May 2022, which is actually quite obvious. If you've been following news, you'll realize that right now there is a war in Ukraine and Russians have been threatening to do nuclear attacks. Now this will definitely sway the odds of victory in their favor, and as I've done in the previous video, I've suggested that since the West is aligned with Ukraine, S&P 500 may reflect the odds of defeat in Ukraine. And just as many wars in the past, there are many turns. The victor can turn to loser, and the losers start to learn and start to increase their odds of victory. Bear in mind, the war that we are seeing right now is a major war. It is not as small scale as the Iraqi invasion. It is not the September 11 World Trade Center attack. This is a full-on invasion on a different country. But wait, there are more negative news that I would like to share with you to hopefully get you a bit more aware and mentally prepared. Morgan Stanley has mentioned that S&P 500 could join the bear market. Join means Nasdaq is currently in bear market already. S&P is hovering at that line. Let's read further. Morgan Stanley analysts suggest that S&P 500 could fall sharply simply because investors are grappling with rising interest rates and slowing global growth. As we now know, China is having lockdown, so China contributes to global growth, and what's happening there definitely will impact many multinational companies. They've mentioned further that this could take S&P 500 to 3,837.25%, which is about 10% lower than as of 25th of April 2022. As always, news headlines come up, take with a pinch of salt. they are also guessing like what we do. Let me show you some data in terms of price earnings ratio for S&P 500. You realize that currently, as of 26 April 2022, S&P 500's price earnings ratio is 21.1 times. And as of now, S&P 500 is around the 4,200 mark. But if we were to look at the mean price earnings ratio for S&P 500, you realize that it's only at 15.97 times. Just now, Morgan Stanley mentioned that it could drop all the way down to 3,800, but I'd like to propose something a bit more severe. What if S&P 500 drops back to the mean? Just the mean, not even the most distressed portion, just the mean. Could that mean that S&P 500 goes down to 3,200? If we were to take a look, this is where it roughly lands. That actually isn't crazy if you think about it, because a climb is never given. And this just means a 33% drop from top to possible bottom. And speaking to here, I'll throw a last further point. I've seen some suggest that in March 2020, Fed was generating a lot of liquidity in the market that drove stock markets and drove a general wealth effect. Right now, Fed seems to be reversing that, which means if you were to not fight with the Fed when they were trying to inflate money around, conversely now, you should not fight the Fed because Fed is trying to shrink the money supply, and therefore stock markets have to reflect that, which also means a possible sharp drop. Nobody can confirm on their thesis, but I'm just putting it out there for you to further consider so that when it comes around, you are not too shaken by it and you are taking the right steps, which is the next section. Now in this last part, I'd like to suggest what are sensible things to do. You know me, I'm a long-term investor. I like to seek caution, but at the base, I'm an optimist. I want to prepare for the worst, yet at the same time not be afraid of losing. And if that resonates with you, help me smash the like button so that we can reach a bigger audience together. Let me share with you my principle of doing things. We don't know what is going to happen on a 100% basis because things change very quickly. When the crash happened in March 2020, it rebounded so abruptly that nobody was expecting something like that to happen. Don't take the notion of sell in May and go away too seriously, because ultimately stock market depends on valuations at that point of time. S&P 500 is rich, a pullback is just normal. And in a lot of ways, it has to reflect the economic situation that's happening right now that will impact earnings of multinational companies. But it all draws down to this. When you invest, do not have that fear of losing. That's why I have these 3 steps for you to think a bit further. The first is don't sell. I've suggested it, I've hinted it throughout this tutorial. If you are doing that, that is emotional buying, emotional selling. Over long term, you won't see good effects on your portfolio. Don't sell, which leads to the second part. Don't buy it, especially if you have investments already or you have too much investments already. This is a strategy I did with Chinese equity. I held back until the end of 2020. No doubt it has continued to slide further down, but not buying at the top or at the middle saved me a lot of heartache. I can still run very far because I'm still not burnt out with that bear market. But also balance this. You need to take action to build your wealth, which means you have to enter the market, and that leads also to don't be afraid of losing. If you entered and it slides further down, don't be afraid. Be prepared instead. And last but not least, if you have a regular investment already, a RSP, continue dollar cost averaging, because that strategy is just to take away the emotions from your approach. That has been proven to be the best way of reducing market timing risk, simply because when things go down, you automatically buy more. And when things go high, you automatically buy less. So as always, if you're looking to improve your own investments, smash or subscribe and check out this previous video I would like to suggest to you, which covers everything on dollar cost averaging. Even seen it inviting you there, and also inviting you to this previous tutorial I've also had that suggested that markets could yet again see new lows in 2022, and very likely at this point of time you're watching, it is indeed at a new low. Check out either of these tutorials and hopefully it can benefit you a bit better in your journey. From this tutorial, take away this new adage: don't sell in May, just go away.